welcome to our Equilibrium Perspectives 2026 halftime report. I'm Jeff Delcourse, President, Head of Financial Planning at Equilibrium Wealth Management. And first and foremost, thank you so much for being here. I hope everybody is having a great summer so far. And as a reminder, we made a change to this format at the beginning of the year where we are now delivering our economic updates through this webinar format, which will also be recorded for distribution to you. This allows us to spend much more time with you during our traditional one-on-one review meetings where we can focus the majority of our time together on your individual portfolios and what matters most to you as it relates to your financial plan. We received a lot of positive feedback as well as some constructive feedback, so we really appreciate it. A couple of things that we have improved on based on that feedback: we now have a Q&A option. So if you do have questions, please feel free to submit those through the Q&A tool. We'll make sure that we get to as many as we can at the end. And those will be anonymous. We're not going to say your name when we talk about the question that you submitted. We've also added page numbers to every slide. So if you're taking notes or have a question that you'd like to address today or during our review session, you'll now see page numbers that you can reference along the way. So with that, let's jump into our halftime report. And boy, a lot has changed since the beginning of the year. And it seems like the investment environment keeps getting more complex. Looking back at the first half of 2026, markets faced some challenges that were expected by investors and some that were unexpected. A new Federal Reserve chair stepped into one of the most difficult monetary policy environments in years. Conflicts in the Middle East pushed oil prices sharply higher and sent ripples through global markets. And a technology spending boom, unlike anything we've seen before, began reshaping the corporate landscape in ways that are still playing out. And through it all, stocks climbed. The economy kept growing and corporate profits surprised pretty meaningfully to the upside. As we turn our attention to the second half, we do remain constructively optimistic. We are optimistic because the fundamental drivers of this bull market, which include real earnings growth, artificial intelligence execution, and a resilient economy, all remain intact. We are cautiously constructive because we recognize that markets have already priced in a great deal of good news and that the months ahead will bring their own set of tests. From a new Fed chair navigating a tricky inflation environment to the approach of midterm elections in November. So our goal today, as always, is to help cut through some of that noise and provide you with our perspectives as it relates to the economy and the markets. So let's take a look at our agenda for today. We'll start with our executive summary, where we'll review our thoughts coming into the year, as well as an update now that we're halfway through. We'll provide you with some of the base facts on the economy. As always, we'll look at the three pillars of the economy: the Federal Reserve, fiscal policy, and the fundamentals of the economy. We'll provide you with an update on the markets, which again have been reaching record highs. We'll talk about what's driving equity markets, and we'll talk about why we think that bonds have actually hit a sweet spot this year. We'll provide you with our updated outlook, taking a look at some headwinds and tailwinds as we move through the remainder of the year. And as I mentioned, we'll wrap up with a Q&A session. So with that, I'm going to turn it over to the founder of Equilibrium Wealth Management and our Chief Investment Officer, Alan Delcourse.
Thank you, Jeff. So for this executive summary, what we thought we would do is put in our comments that we had at the beginning of the year, and then make some update comments to the right, which are in bold. First comment we talked about was the Federal Reserve being stuck in neutral. Remember that the Federal Reserve has two mandates. One is for full employment and one is for stable pricing. Back in the beginning of the year, before the war in Iran, they were kind of pulled between the two. But now we see an increase in inflation. We think that they're now looking to raise interest rates. And we'll show that in one of our charts. We expected above average trend line growth in GDP. The first quarter was only at 2.1% growth, which was trend line, but we still think it's possible to have above average growth, especially with the significant corporate capital expenditures. Remember, GDP growth is consumption, government expenditures, and corporate expenditures. We said there was a bifurcation. We talked about the K-shaped economy between two groups of consumers, and that seems to be growing every day. And we're going to spend a little bit of time on that. U.S. business cycle, we said, remains constructive. Corporate America is thriving, and that's confirmed. Corporations are making tremendous amounts of profits. It is tilted towards some of the largest companies that are making unbelievable profits this year. We said we believe the markets are due for an increase in volatility, and that's been confirmed. We saw the volatility once the war in Iran started. We're going to see more volatility in the second half of this year, especially because of the midterm elections. We believe the strength of fundamentals worldwide should create positive return for global equity markets in 2026. That's challenged by the war in Iran, especially for emerging markets who import, 70 or 80% of their energy needs. But it's still probable for the other reasons we've talked about. So as we stand right now, key considerations: the war in Iran has caused global consequences. The key is inflation right now, too. Is this added inflation that we see, is that just kind of transitory, or is it more enduring? Will it bleed through the core of the economy? And then how will the Federal Reserve react to it? We'll also take a look at why our market's doing so well this year. So with that, let's take a look at base facts on the economy. The Fed funds rate right now is 3.75%. Maybe it goes up to 4% this year. In our opinion, that's kind of the neutral rate right now for federal funds rate, which means that they're neither stimulative nor restrictive. Inflation, the Federal Reserve uses the core PCE as their favorite index for inflation. That right now is at 3.2%. The problem is that their goal, the Federal Reserve's goal, is a 2% rate. Unemployment is relatively low right now at 4.2%. Over the last 75 years, unemployment has averaged 5.6%. GDP, we mentioned, growing at 2.1%. We think that will expand this year. And something that we'll focus on a little bit later is the U.S. debt at $39.3 trillion and growing every day. So let's take a look at the Federal Reserve. And there's a new sheriff in town. Kevin Warsh has just been named as the chairman of the Federal Reserve. It gives us some comfort to know that he's got experience. He was a member of the Board of Governors of the Federal Reserve back in 2006 through 2011, a 5-year period, which meant that he was there in 2008, the Great Recession. So he's got experience, and he comes into his role with his thoughts about the way the Federal Reserve should be. He's made it very clear that he wants to focus on price stability right now and take a tougher stance on inflation. With his role in 2008, he saw how the Federal Reserve balance sheet grew significantly as it did in 2020. He doesn't like that. He wants a more leaner Federal Reserve. He's launched task forces to review key areas of the Federal Reserve, including the balance sheet, how to get more timely information, more data. And he really wants to simplify Fed communications. Reducing forward guidance is a must for him. So let's take a look at the importance of the supply of money. It's important to the economy because if the supply of money is too low, it can restrict an economy. If it is sufficient, it can help an economy grow. If the money supply is too high, it can lead towards more inflation. So when we look at this chart, we take a look at what we call M2 money supply. And that is simply checking accounts, savings accounts, short-term CD, short-term money market accounts, money that can easily be turned into spending. When we talk about velocity, we talk about the multiplier effect. How much does that money in a system turn and how active is it? As an example, if you put $100,000 into a bank account, the bank would keep $20,000 in reserve, and it has the ability to lend $80,000. So that's that multiplier effect. In our opinion, money supply right now is large enough to support the growth that we see in the economy going forward. So the war in Iran, its impact on the Federal Reserve, its impact on inflation, military spending right now, with higher military spending and higher energy prices due to the war in Iran, has cost the U.S. about $100 billion, over $750 per household. We know that the closing of the Strait of Hormuz has caused shortages, higher prices. Nearly 20% of the world's energy demands pass through the Strait of Hormuz. But it's more than that. It's fertilizer for farmers. It's the sulfur that's needed for batteries, methanol for resins and plastics, helium for semiconductors. The rise in the price of oil and reduction in strategic oil reserve. There's obviously a global impact on the price of jet fuel, gasoline, natural gas, liquid natural gas, etc. And when we take a look at the strategic oil reserves, they're at the lowest level they've been in nearly 50 years. So the question is this just a geopolitical event? We follow Liz Ann Saunders from Charles Schwab. She made this comment: this is not just a geopolitical event, it is a structural energy supply shock. Let's take a look at this next chart because, it's important. We keep talking about the Strait of Hormuz, but this whole war is more than just pressing a button and the strait is open or the strait is closed. Look at all of the areas that were bombed, and whether they were oil depots or refineries or pipelines. And this was before the recent escalation in the war. So it's more strategic in nature. It takes months, it takes years to rebuild some of the areas that were damaged in surrounding countries to Iran. So we talked about the Strategic Petroleum Reserve. That's a large reserve that was created for crisis markets. We've been depleting that reserve in crisis markets and non-crisis markets. So again, it's the lowest level in 50 years. On the right-hand side, we see the price of oil and we see the volatility of it. One thing that caught my eye the other day in looking at this chart is look at April 21st of 2020. The price of oil per barrel was $12 during COVID. It went up significantly to the $124. You see the volatility. Recently, oil hit $120. It's come back down. It's now around $80 or so. So there's a lot of volatility in this part of the world. So what is the Fed going to do? The Federal Reserve, as we mentioned before, follows the Personal Consumption Expenditure Index, the PCE. This chart goes back a little bit. It shows how inflation really took off after COVID, because you had so much in fiscal stimulus, everybody was getting a check, had so much from the Federal Reserve and making money easy, lowering interest rates to zero. And then we had a significant level of inflation, as high, I should say, almost as high as we had back in the 70s, the highest level since the 70s. Then the Federal Reserve raised interest rates, inflation started to come down to the 3% level. And now more recently, we're starting to see that uptick. 3.5% on headline PCE and 3.2% on core PCE. What this chart also demonstrates is that it's been over 5 years since we've reached the Fed target of a 2% inflation rate. Remember, the other mandate of the Federal Reserve is full employment. We talked about a low unemployment rate, and this chart talks about non-farm payrolls that are the payrolls coming into the labor market on a monthly basis. And if you get something in that $100,000 to $150,000 range, that's a pretty good steady number. You can see though how that number has come down, and there was more concern about labor. Recently, that has started to pick up. So with unemployment at 4.2%, there's good signs the labor market is stable, although there are some chips in it that we have to be careful with. So what is the Federal Reserve going to do? Here's a long-term chart looking at the Fed funds rate. Remember, though, that's the base rate of short-term rates. This is the rate that the Federal Reserve can control. And you see the volatility over the years. You see in 2020, the rate was just about zero. And then the Federal Reserve raised rates at one of the fastest paces ever to fight inflation. At a little bit of a plateau, rates have come down, and now we're seeing kind of a sideways market, sideways rate of Fed funds, which again we think might be that neutral rate of the Fed funds. But this is showing clearly that the market and the Federal Reserve feel that they will be raising interest rates at least by the end of this year.
Okay, so moving into the second pillar of the economy, which is fiscal policy. And as a reminder, fiscal policy is how the government uses taxing, spending, borrowing, and other policies to influence the economy. For those of you that joined us in January, you'll remember we talked about the elephants in the room surrounding fiscal policy. Since then, we've somehow managed to squeeze in a few more into the room. And at this rate, we're going to need a bigger room. One of the big issues we've talked about extensively was tariffs. So I guess good news on this front. Tariffs are now less of an issue than they once were as it relates to the markets. You'll probably remember back in late April of last year on what is now known as Liberation Day, the proposed tariff rate would have been the highest since the Smoot-Hawley Tariff Act in 1930. The proposed rate was around 30%, which is shown by the orange bar. Since then, things have changed quite a bit. The Supreme Court ruled that tariffs imposed were unlawful, meaning that many businesses and importers are now expected to receive refunds. In response, the Trump administration quickly implemented a temporary 10% baseline tariff under Section 122 of the trade rules, while it continues looking for more permanent and legal ways to implement its trade policy. The bottom line is that tariffs remain a key part of U.S. trade policy, but the market has been encouraged because the end result has been much less severe than what was originally proposed. Tariff rates are still well above where they've been for most of the past few decades, but they're also well below the worst case scenario that investors have been fearing over the last year or so. Another elephant in the fiscal policy room, which we've talked about many times, is the budget deficit and our national debt. This is an issue that is just not going away anytime soon. Our national debt has now climbed to more than $39 trillion. It's over $115,000 for every person in the US. And if you look at the projections, our debt to GDP ratio, which is already around 100%, is expected to continue moving higher. So why does this matter? The more money that the federal government has to borrow, the more it competes with everyone else who needs to borrow, whether it's states, cities, businesses, or consumers. And that competition can put upward pressure on interest rates and keep borrowing costs higher for longer. Now, this isn't an immediate crisis, but it is something that is becoming a much bigger long-term challenge that both policymakers and investors need to be paying attention to. It's also one of the reasons we continue incorporating alternative and non-traditional investments into portfolios. We don't know exactly when or if this elephant in the room starts causing problems, but we'd rather be prepared than surprised. And speaking of our national debt, going back to the war in Iran, it doesn't just have implications for monetary policy and the Federal Reserve. It also has clear implications with respect to fiscal policy. We all know that military conflicts are extremely expensive. Even if the U.S. avoids a prolonged ground war, increased military operations, rebuilding weapons inventories, and expanding defense commitments all add to federal spending at a time when we're already at these massive levels of debt. Iran also has some pretty meaningful leverage over the U.S. and its allies through its ability to disrupt shipping in the Strait of Hormuz. So we believe this could remain an ongoing issue with periods of escalation and calm. We seem to be in a new period of re-escalation. So this is just not something that's simply going to disappear from the fiscal and geopolitical landscape. And so what do some of these fiscal challenges, these fiscal elephants in the room mean for market interest rates? And when we say market interest rates, we're making a distinction between the short-term rate that the Federal Reserve controls, what Al just talked about, which is the federal funds rate, and the longer-term market rates tied to Treasury bonds, which influence mortgages and many consumer and business loans. So this chart shows both nominal and real interest rates from 1958 through today. And after a decades-long decline, long-term interest rates have moved higher in recent years. Looking ahead, the fiscal elephants in the room that we just talked about could keep upward pressure on long-term market rates, keeping them elevated even if the Federal Reserve lowers short-term rates by way of the federal funds rate. And finally, as we look ahead to the November election, one question we hear frequently is what happens if there's a red wave or a blue wave? At this point, we don't see a red or a blue wave. If anything, we think the probability is on a split Congress where Democrats may be able to take control of the House, and then Republicans maintain their control of the Senate. So kind of more gridlock. But the reality is that while specific policy may differ pretty greatly between blue and red, the common denominator is that neither party appears likely to significantly reduce the federal deficit or slow the growth of our national debt. So we expect government borrowing to remain elevated regardless of which party is in power. So regardless of what happens, fiscal policy is likely to remain a major driver of the markets in the years ahead. From an equity market perspective, midterm election years have historically been the most volatile of the four-year election cycle. We've already seen some of that this year, but a lot of that volatility has not been tied to the midterms, right? It's been tied more to what's happening overseas in the Middle East. So as the election season heats up, that volatility could certainly creep back into the markets. That said, once the dust settles, history shows that markets tend to shift their focus back to what really matters for long-term returns, which are corporate earnings, interest rates, inflation, and economic growth, not which party controls Washington.
All right, let's jump into the fundamentals. First thing we want to take a look at is who are the drivers of consumer spending. The chart on the left shows a couple things. First of all, it shows that the gross net worth of individuals in the United States has never been higher. It also shows that the top 20% of by income have enjoyed 70% of the growth of net worth over the last 6 years, meaning that the bottom 80% have only enjoyed 30% of the growth. And it makes sense, right? Because a higher net worth Individuals have more investments in 401ks, other investments, they own businesses, they have higher income, etc. So again, a reflection of the K-shaped economy that we've been talking about. On the upper right-hand side, we can see pre-tax income. The top 20% of earners spend approximately 40% of the total spending, where the bottom 20% are only 9% of spending. So you can see it's the upper cohort of income earning consumers and net worth. The lower right-hand side, we take a look at tax refunds, which has been a help, at least for the bottom 80%. Tax returns were higher this year based on what happened with the big, beautiful bill that was passed last year. When we take a look at consumer sentiment, and again, this represents the average consumer. So the average consumer doesn't feel very well right now. Their sentiment, if we take a look all the way on the right-hand side, is near an all-time low. So, there's certain pockets of consumers that are doing very well. The average consumer, the other 80%, are concerned about what they see going on in the world today, going on with inflation, going on with their job prospects, etc. And how does that compare? We take a look at this next page. What is driving GDP growth? So the yellow line is the University of Michigan consumer sentiment, and again, we see how it's come down significantly. But the S&P has gone up significantly. And again, that's based on the earnings from the underlying companies, et cetera, et cetera. The other part of this is that as the S&P goes up, as equity markets go up, that adds to the net worth of those that have the higher net worths. So again, another reflection of the K-shaped economy. So where are we in the economic cycle, and what are the probabilities of recession? We're using this chart to start out. It's the business cycle in September 2023. And remember, there's 4 stages of the business cycle. You come out of a recession, you have the early stages where the economy is getting back into action. The middle stage, you have growth, you have good credit. The Federal Reserve is typically neutral in that part of the cycle. The late cycle, things start to mature, maybe credit tightens, and then that finally leads to the recession. So if you take a look at the dots, and this was approximately 3 years ago now, let's take a look at where we are today. As we look at this next chart, we see a couple things. We see that China on the left-hand side is starting to come out of their recession, as is the Eurozone and Canada. But other countries like the US, India, and Japan have backed up into the business cycle with a chance for kind of a redo. And it makes sense because our economy has reached another level of strength, as we're talking about, good GDP growth, good employment, etc. So it's good to see it. It's very infrequent that this happens, but it's good to see that we have this longer runway towards the later stages and recession. Now, when it comes to recession, this is a chart that we use from ClearBridge, an analysis research that they do. And if you look on the left-hand side, it shows May 31st, 2026. What they do is they take a look at all these indicators, housing permits, job sentiment, ISM new orders, breaking it out into categories of what affects the consumer, business activity, and financial. And you can see all the green arrows. Just job sentiment has the red X. And the overall signal is that we're nowhere near a recession based on this analysis. Now, the next chart we take a look at, well, how does that compare? Again, the far left-hand side is current. How does that compare with prior recessions? If we look at 2007 and 2009, that reflects the 2008 Great Recession. Look at all the X's there with, some yellow circles. We look at 1990 and 1991, they're all red X's. So the point here is that based on economic activity where we stand right now, we think we have a longer runway before we have to worry about and be concerned with recession. So look at corporate activity, a focus on AI, artificial intelligence. We talked about the driver of the consumer. Now we'll talk about the driver of investment. And that is all the money that the hyperscalers are spending on data centers. The hyperscalers are listed here. It's Alphabet, Amazon, Meta, Microsoft, Oracle. This year, looking to spend $723 billion on the build out of data centers, which creates the infrastructure they need for artificial intelligence. I'm old enough to remember that years ago, if you looked at an economy and if you looked at a fiscal stimulus of $100 billion, maybe $200 billion, that was exceptional to increase the economy. At this point in time, we are so large that $723 billion is coming in just from corporations. So that's real money. Okay.
All right, turning our attention now to an update on the markets. As we look at the S&P 500 on this chart for the first half of the year, you can see that the market hit a rough patch and a little bit of volatility in March as the conflict with Iran pushed oil prices higher and reignited inflation concerns. Certainly grabbed headlines, but it turned out to be a very short-lived event for the markets, at least so far. As the market embraced talks of de-escalation, the second quarter ended up becoming one of the strongest market performance quarters in the history of the S&P, believe it or not, surging by 15% in the second quarter, which was the single best quarter since 2020 and the second largest quarterly gain since the 2008 financial crisis. And that is even with a bit of a pullback that we saw in June, which is normal and healthy after a big rally like we saw. So, for the first half of the year, we saw when we incorporate Q1 performance, which did include that downturn, the S&P for the first half is up 10.2%, but that's only part of the story. After years of underperformance, we saw small and mid-cap stocks outshine the large cap S&P 500 index by quite a bit. Small caps were up almost 24%, and mid caps up about 17%. Not listed on this chart, but we also saw international and emerging market stocks do quite well. So diversification amongst various stock asset classes certainly helped in the first half of the year as we're looking at that higher risk equity portion of portfolios. Now, if we extend performance for the S&P 500 out a little bit on this chart, let's focus our attention on just the last 4 years here, since the bear market of 2022. And you can see we've had this dramatic climb of about 106% for the S&P 500, albeit with corrections and downturns along the way. So it makes sense to ask questions about our standing in the financial market cycle and the psychology of investing. As many of you know, one of our favorite quotes, we talk about it a lot, comes from Sir John Templeton, who is widely regarded as one of the greatest investors of the 20th century. He said that bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. So naturally, we need to be carefully considering if the markets are in a state of euphoria right now. And we certainly see some pockets of euphoria. We see record highs in equities, record inflows into equity ETFs, extremely low credit spreads, which means that investors are accepting very little additional yield for riskier bonds and safer bonds. That's kind of a signal there towards euphoria. And then, of course, we've got the example of SpaceX. So let's focus a little bit on SpaceX for a moment. I know there's a lot of interest out there. And when SpaceX became public, we completely understood the excitement. It is one of the most innovative companies in the world, and we received, a lot of questions on whether it was a good fit. Our answer at that time was to be very cautious, and this is why. The IPO was priced at $135 per share, which valued SpaceX at $1.77 trillion. It was the largest IPO in history. Within days, excitement pushed the valuation to nearly $3 trillion, which briefly made it worth more than Amazon. The challenge was that the fundamentals simply didn't support the price. SpaceX in 2025 generated about $19 billion in revenue. And in comparison, Amazon generated over 700 billion. And yet again, for a moment, SpaceX was worth more. Morningstar estimated SpaceX's fair value at roughly $780 billion, less than a third of the valuation it got to at its peak so far. So talk about euphoria, right? Today, that stock price has pulled back to around $136 per share, at least as of yesterday. I'm not sure what it's doing today. That's just $1 above its IPO price. So a significant decline from its highs, and could potentially continue to slide once earnings history becomes more public and insider selling as lockup periods expire. All of this could create additional volatility. None of this means SpaceX won't become a phenomenal company. It simply means that great companies don't always make for great investments at every price. So certainly there's pockets of euphoria in the marketplace. But let's look at one of the themes that we've talked about throughout this presentation so far, which is AI. It's a theme that's been driving a significant amount of market performance across all asset classes, causing some investors to have this concern that are we in this .com-like bubble with AI? Many of you will remember the late 1990s .com boom and then the painful bursting of that bubble that followed. If you look at the chart on the left, the green line on this chart represents the stock price growth of what were called the four horsemen of the .com era. So that was companies like Microsoft, Cisco, Intel, and Dell. The dotted line represents their forward earnings growth. So you can see that the growth of their stock price far outpaced the growth of their earnings. That is certainly a bubble and euphoria. Compare that to the chart on the right, where we look at today's largest AI exposed companies. So this chart includes NVIDIA, Microsoft, Apple, Amazon, Meta, Broadcom, and Alphabet. And here you can see that dotted line that represents earnings growth is actually outpacing the growth of the stock price. So in our opinion, it is still way too early to let the risk of a potential future bubble in AI overcome the opportunities presented by this game-changing technology. There could still be plenty of room to run, albeit with bouts of volatility and corrections along the way as healthy skepticism comes into play. And as you all know, we remain heavily diversified and balanced well beyond the technology and AI sectors of the market. When we look at why the market has stayed so resilient, one of the biggest reasons, and again, why we don't think we're in a full-blown euphoria phase yet, is earnings just across the broader market. So we're looking at the S&P 500 here. And if you look at 2026 earnings estimates, they've actually surged this year from about 13.6% expected earnings growth at the beginning of the year to over 23% expected for 2026 as it stands today. And that's really unusual. Normally, analysts spend the year lowering their estimates as opposed to raising them. And remember, at the end of the day, earnings are what drives stock prices over the long run. The more money companies make, the more they can reinvest into their business or return to shareholders through dividends and buybacks. Now, here's the flip side. Earnings growth above 20% is pretty rare this late in a economic expansion. So while these strong earnings are absolutely supporting today's market, they've also raised the bar quite a bit. If companies continue to deliver, that's great. But if they start falling short of these very high expectations, that's when we could see some volatility return. And we saw that with IBM. Was that yesterday, Al?
Yes,
IBM came in a little
dropped
bit under their
25% yesterday.
under their earnings estimate, and the stock dropped about 25%. So that's one example of where these high earnings expectations could certainly add a little bit more volatility into the market as well. Turning now to bonds, I mentioned this earlier. This is one of the most attractive environments we've seen for fixed income in several years. If you think back to early 2022, the Bloomberg U.S. Aggregate Bond Index was yielding less than 2%. And the Federal Reserve had very little room to cut interest rates if the economy weakened. Today, we've got a completely different story. We've got high quality core bonds that are yielding 4.5% to 5%, providing investors with meaningful income before you even factor in potential price appreciation. That income also helps cushion portfolios if interest rates do move modestly higher. The gauge for interest rate sensitivity is duration, and that has come down quite a bit in the last couple of years. Perhaps more importantly, bonds have reclaimed their traditional role as a diversifier. With the Fed now having about 350 basis points of potential rate cuts available, if economic conditions do weaken, high quality bonds are once again positioned to help offset equity volatility during periods of market stress. So today, bonds offer that rare combination of attractive income, potential capital appreciation, and diversification, which are all three qualities that bonds have really been missing over the past several years.
All right, let's take a look at our outlook, and we're doing it through the lenses of headwinds and tailwinds. So the headwinds, let's kind of go through that. Obviously, the war in Iran with significant disruption to the global economy. We think there's a probability at this point that the Federal Reserve will raise interest rates because inflation looks more sticky than rather than transitory. There will be consequences to high U.S. Debt levels. We see that market rates are starting to increase, so that's a concern. There's that concentration of wealth in the U.S., and the question is if there's a crack in this wealth effect, stock market prices come down for whatever reason, and the upper echelon of the K-shaped economy stop buying as much as they have been, that could disrupt the economy. There's relatively high valuations in the markets right now, although earnings is helping to keep that down. But with volatility, we think the gains going forward for the rest of the year will be limited. There's the uncertainty over the midterm elections and a continued risk of geopolitical concerns, whether it's still the war in Iran or somebody else. So as we take a look at the tailwinds, the U.S. business cycle, as we've talked about, remains constructive. Capital expenditures are significantly increasing GDP. U.S. companies are showing great returns of profits. Productivity is high, and that has an advantage both for companies and for workers. The rate of new business formation is growing. That's important to a growing economy. Our labor force is close to full employment. More jobs means more spending. The U.S. tax refunds that have kicked in this year have helped negate some of the impact of the war in Iran and in inflation. And the wealth effect that we've seen so far is enduring, and that certainly is a tailwind for the economy. So to summarize, we'll say that we think that for the balance of the year, we're going to see further gains in the markets, albeit with volatility. We had a correction in the interim. We wouldn't be surprised. Although overall, I think the gains in the second half will be more muted. There'll be uncertainty because of the midterm election. That's going to create more volatility. The AI revolution is here. It's a significant part of the growth of our economy. We looked at a recession, the recession chart. Recession looks unlikely, which reduces the risk of short-term issues. Thinking outside the box, we wonder whether in a reverse role, whether a decline in the markets, again, for whatever reason, might cause the upper echelon of the K-shaped economy to spend less, which might lead to a reduction in activity in the economy. Bottom line, we feel our portfolios are well diversified for what we see in the economy and the markets. We're well diversified and we look forward to the second half of this year and beyond.
All right, awesome. So that is the conclusion of our presentation. As a as a reminder, if you do have some questions, please click on the Q&A feature at the bottom of the screen. We've got a lot of questions so far, though, Al, on the new Fed chairman. And so while we're waiting for some other questions to come in, can you expand a little bit on the role of the Fed chairman?
Yeah, I think that's important, Jeff. That's a good question. Kevin Warsh is the chairman of the Federal Reserve, but it's important to remember that he is only one voting member of the Federal Reserve. He does come in with a lot of experience, so that's really good. And his challenge now is to kind of shape the Federal Reserve. While he only has one vote, he can do some jawboning and try and get the other members to vote the way that he sees, whether it's on interest rates or the Federal Reserve's balance sheets or whatever. What's interesting too is that Chairman Jerome Powell is still a member of the board of directors, of the board of governors. It's very rare that a former chairman would stay on, but Jerome Powell did stay on. He's one of the members. He said that he was going to kind of keep in the background, and so far he has. But we'll have to see how this board gets along, how coordinated they are, and whether it's a increase in interest rates or keeping the stability or lowering interest rates. So Chairman Warsh has his challenge ahead of him for sure.
Yeah, and it'll be interesting to see how the communication differences between what we're used to from the Federal Reserve and their comments and their forward guidance, how that changes going forward. As you had mentioned, he is a big proponent of limiting information that they're sharing with the general public. So I think what that will likely mean is that could create additional volatility around inflation numbers and jobs numbers, because we're not getting that solid guidance and information from the Fed in terms of what they're thinking as it relates to those new numbers coming out.
Yeah. Jeff, while we're waiting for the next question, another point I think is important to make is that when we look at the market this year, there's the market index that we see, and there's the activity below the market index. And there's been this rotation underneath the surface. So while the market looks like it's hitting new highs, which it is, there's a lot of activity going on under the surface, a lot of rotation. So it's interesting that the average constituent in the S&P 500 this year has had a peak to trough experience, a high to a low of a minus 20%. So while the market looks stable on the surface, underneath there's rotations. Sometimes it's software, sometimes it's hardware, sometimes it's, energy, etc. So And that's actually a good thing because we just don't want to see the market go up smoothly without any issues. You've got to have corrections. You've got to have create a new foundation for the market. And it's doing that under the surface.
Yeah, and for the last 8 weeks now, we've had kind of this flat performance in the S&P and just kind of the broad headlines, which I think is healthy as well. The market needs those periods to kind of digest information and set the foundation again to continue to rise. And maybe that means less downturn if there is, you know, bad news that comes out. We've got more guardrails for events that might come up.
Yeah.
We do not have any other questions that came through, so sounds like we did a pretty good job explaining everything. We will wrap up here. We're just going to click through some important post-presentation compliance disclosures. We do want to thank you once again for being on this call today. If you have any feedback, we would certainly welcome it. Also, as a reminder, if you do have any further questions related to the material we presented today, you were too shy to submit a question, please feel free to email us or give us a call, or we can discuss those questions at our upcoming one-on-one review meeting. If you haven't scheduled that meeting yet, which I think most of you have, but if you haven't, please remember to do so. If you need that link again for scheduling, let me know and I can resend that to you. As always, thank you so much for your trust in what we do. As you know, we're always looking out for your best interests, whether that's from an investment management standpoint or other financial planning items. We are absolutely here for you. If there is anyone else that you think could benefit from our services, we'd love to discuss how we might be able to help. With that, thank you all very much. We hope you have a great rest of your day. If you're in the Midwest, we hope you stay cool, and we'll talk to you soon.
Thank you very much.